So Ireland is still in great shape since we last had our presentation. A couple of things have changed. Oil prices have gone up more and we have had a slowdown in the euro area. So things are not quite as good as they were, but still pretty good. Today, I'd like to cover three areas. Firstly, to look at our fiscal situation and the context of where we are in the cycle. Secondly, to look at our long-term picture, which is very, very favourable. And then, of course, things have changed a little bit in markets in recent weeks with the Italian political situation and the movement we've seen. So what does that mean for Ireland? So we've seen a big move in the Italian bond market in the last few weeks, but that isn't really the news for Ireland. The insight for us is that Ireland has hung in with the group of what we call semi-core countries, the likes of France and Belgium, and we haven't had a sell-off like they've seen to some extent in Spain and Portugal. The question for us then, of course, is can we move to the very next level, which would be to join the core group of countries. And that might take another leap in our ratings. So ultimately, we have seen Ireland's rating rise to the high A level, but we'd probably have to get to the AA level. And rating agencies have hinted that for Ireland to get there, we'd probably need to see a budget surplus here in Ireland again to join the other 13 countries in the European Union who are already seeing their revenue exceed their expenditure. We've mentioned before how Ireland has a relatively high debt level. The easiest way to bring that debt level down would be to run a budget surplus and to use those monies to repay debt. Our debt level stands at above 200 billion euro. And if we think of debt servicing capacity, Ireland's debt to revenue would be similar to a country like Spain. Yet Ireland is trading much better than Spain in the bond market, perhaps because of its better long-term growth prospects. Why that high debt level matters is because we're entering the later stage of the economic cycle. So we have some classic late cycle signs such as the US raising interest rates and rising oil prices. We've mentioned before that ultimately if we get to a point where short-term interest rates in the United States go above long-term interest rates, that has predicted 9 out of the last 9 recessions. So we should take advantage of current circumstances. So we know that Ireland has a great business environment, but perhaps what is less well understood is that Ireland has very favourable demographics. It has the youngest population in the EU 28 at a median of 37 years, and that compares at the high end to Italy and Germany at 46 years. And the great thing about the demographic structure is that we've some idea of what the population will look like over the next 15 to 25 years, unless there are wild swings in migration. It's not really until 2040 or beyond that Ireland will run into problems about ageing cost or healthcare cost as the population does move into older age. The good news is that Ireland has made some steps to deal with those issues. So we've raised the retirement age, and by 2028 it should be 68 years. So just to recap, I focused on the recent market moves in Italy, the insight for Ireland that we're holding well in there. Of course, we still have a high debt level, and that is important as we move into the later stages of the economic cycle. But looking longer term, Ireland's demographics are very favourable for fundamental debt sustainability.